Eric, the room's rotating around you.
Yeah, I'm taking this call from Charleston, Professor, and just figured
Okay.
I'd avoid the glare on me.
Okay. Thank you. Hi, Michael.
Hello.
Bender, you look like you just got out of bed. Your hair's all you got bed hair.
New style.
Welcome, folks. So if you can turn your cameras on again, I'd appreciate it. But as I said, I'd leave that if you don't feel quite ready to turn the cameras on, that's okay too. Welcome, and thank you for doing this class online. I know this is something you'd hoped to leave behind you a couple of years ago, but it kind of means that I don't have to miss a class. So no, before I get started, it's been a week. I don't want to kind of put you in an embarrassing position of not remembering what we did a week ago, but we were talking about equity risk premiums. Anybody want to remind me what the end game here is? What exactly does the equity risk premium measure? Jacqueline, you want to try? What does the equity risk premium measure? What is it supposed to measure? Give it your best shot. It's a week, so everybody's kind of rusty.
Yeah, of course. So the equity risk premium is supposed to measure the difference between the market risk and potential equity that you would need for a company.
It's the difference between what you would expect to earn on an average risk equity investment and the risk-free rate, right? So that's the mechanical. It's that number in the brackets when you use the CAPM that you're trying to measure, right? But Nishank, what drives that number? Why does that number go up or down? What do you think it is a barometer of?
I'm not sure, Professor.
Right. Anybody else want to try? What does the equity risk premium reflect?
Could it be the 10-year treasury, the Fed fund rate?
That's a risk-free rate, but this is what you're demanding over and above that, right? Why does that number vary across time and vary across people?
The underlying risk.
And how risk averse you are as a person, right? I mean, remember the saying they say about markets being about fear and greed? The equity risk premium is a reflection of both of those things. When fear increases, the equity risk premium will go up, and when greed increases, it will go down. So it becomes the ultimate barometer for where's the market right now? How scared are people? Are they getting greedy or are they getting fearful? So the equity risk premium has to be a number that's dynamic, because clearly that feeling you have varies across time. The market shift over time. So we looked at the primary way in which people estimate equity risk premiums, which is look backwards, a historical risk premium. Now you understand why that has appeal, right? Because it means you have a number. It looks like a fact. You can look at the last 100 years. Over the last 100 years, I'd have made 5.23%. And you feel pretty good. It's a number. It looks precise. But we pointed to the dangers of historical risk premiums, and they're threefold. One, they're backward looking by definition, right? You're looking at the last 100 years when you want the equity risk premium for the future. Two, they're noisy. What does that mean? That number you get even by looking at 100 years of data is a big standard error. If you remember, the standard error we got on the equity risk premium of 5.2% was 2.1%, which means the true risk premium can be anywhere below 1% to over 9%. And three, it's static. What does that mean? You could be in the middle of the biggest crisis in history, but if you're looking at a 100-year historical risk premium, it's going to stay the same. It's not going to shift because you got 100 years of data weighing you down. So I did mention in class that until 2008, I would cut some slack for people using historical risk premiums, but I don't think there's any basis for doing that anymore. The world has changed. Looking at the last 100 years of US market data is not going to give you a good indication of what the equity risk premium should be for the future. So I suggest an alternative. And since we did this at the very end of the class, let me go through the alternative. It's a forward-looking dynamic premium. So what does that even mean? I have a very simple saying on equity risk premiums. I'm not going to ask you what you think your risk premium is. I'm not going to listen to what you say because you can come up with any number. If you remember in class, I gave you that exercise. You got a guaranteed investment on which you're making 3%. How much more than that would you need to make to invest? And we came up 5, 7, 9. And we at different points, you said, I feel comfortable doing that. But it's still all words, right? Anybody can say whatever they want about the equity risk premium, but what you pay tells me a lot more about what your equity risk premium is than what you say. Let me explain. When you feel scared about the future, remember, you can't change the cash flows of the future. What's the only thing you control? Whether you buy or sell, right? So when you feel scared about the future, what do? You sell things, you lower the price. You're telling me your equity risk premium just went up. So every time you buy or sell, you're sending me a message about your equity risk premium. So I borrowed from the bond market. I said, you tell me what you pay, I'll back out from this what your equity risk premium is. So let's make this real. November 2013, I'll give you the updated number as of February 2024. In November of 2013, the S&P 500 was at 1,756.54. That's what you paid for stocks. Now, what do you expect to get as cash flows? I don't know, but I can tell you what those cash flows were. In the last 12 months, those cash flows would have amounted to 82.35. Now, notice I'm not putting units like billions or trillions because this is an index units. You know what that means? Because when you look at an index, nobody says the Dow Jones is at $38,800. It's index units. You basically take market cap and convert it into index units. So I know what you paid. I know what the cash flows were last year. But you're not paying for last year's cash flows when you buy stocks. You're paying for future cash flows. So here's what I bring in. I bring in what analysts are estimating as expected growth in earnings. I know analysts can be wrong. They can be over-optimistic. They can be hubristic. All of those things set aside, these are the expected earnings for the future. The S&P 500 is the most tracked and followed index on the face of the earth. There are people whose entire
Professor, I think your screen's frozen.
Alex Heyman, you're unmuted as well.
Well, does anyone want to take over the class?
I'm sorry, I didn't know what happened. Let me pull up the slides again. Technology, you can't live with it, you can't live without it. Can you see my screen?
Yes, sir.
Okay. Can everybody see my screen? I just want to make sure that okay, good. So with an implied equity risk premium, here's what we do. We take what you paid for stocks, we project out the expected cash flows, which can come from
Professor,
dividends
we
as
cannot
well
see the
as stock
slide.
buybacks. Okay. So if you look at the dividends and stock buybacks in the most
We
recent.
cannot see
Excuse
the
me,
slides,
Professor.
Professor. We
Mela,
can
you
only
can't
see
hear
the
or what's going on?
presentation.
I think you.
Some presentation, random presentation.
Yeah, I think you're
Can
projecting
everybody-
the wrong
presentation.
Okay.
file. I think.
Mela,
It's empty,
do
Professor.
you have something?
It's empty, Professor. It's a
I
new
can't hear
slide.
you.
The PPT is
let's see.
empty.
Maybe my mute is off. Okay, I just want to make am I coming through? I don't want to talk to an empty room or
Professor,
maybe-
you're audible, but you're projecting a wrong file. It's a blank presentation right now on the screen.
Okay, let me do that again then because thank you. How about right now?
Yep, that's good.
Okay, good.
All
Sorry. Okay. So what I've done is essentially taken what you paid for stocks, projected out the expected cash flows, growing at what analysts are projecting, 5.59% a year. And here's the final loose end I've got to tie up. I can't grow earnings at 5.59% a year forever. And here's why. These are the 500 largest market cap stocks in the US. Their earnings can't grow at a rate faster than the US economy, nominal terms, forever. Why? Because then the earnings will blow up. So at the end of 5 years, I stop and I say, okay, I want to estimate a growth rate in the US economy after year 5. You know what a nightmare that is to do? You ask macroeconomists, they don't even know what the growth rate will be this year. Forget about 5 years out. So I fall back on something that I find has stood me in good stead. After year 5, I assume that the growth in earnings for the S&P 500 is going to be 2.55% a year forever. You're saying that sounds awfully precise. Where are you coming up with that? I've set it equal to the risk-free rate. If you remember, when you talked about risk-free rates, I said risk-free rate is composed of expected inflation and an expected real interest rate. It's actually a very good proxy for nominal growth in the long term. So I have the equation set up. There is a level of the index, expected cash flows for the next 5 years, and beyond year 5, a growth rate in perpetuity of 2.55% a year. I compute an internal rate of return. In other words, I solve for this discount rate. It's a little messier than solving for the yield to maturity on a bond because their terminal value is going to be a function of what your discount rate is. So I have to use the solver function in Excel. Thank God for that. If I didn't have that, I'd have to do trial and error. Wouldn't take me that long. You have to try different rates, converge. But with the solver function in Excel, when I solve, I come back with 8.04%. You ask me, what does that even mean? In November of 2013, if you bought US stocks, I don't care what you hoped you would make, what you prayed you would make, given what you were paying for stocks, you'd have made 8.04% a year. You subtract out the risk-free rate, my implied equity risk premium in November of 2014 would have been 5.49%. Now, here's why this matters. If you look at in November 2013, trying to look at companies and coming up with an equity risk premium, I had two choices. I could do what everybody else does, which is to go back and look at historical premiums and use 4.2%, which is the geometric average historical premium then. Or I can come up with an implied premium of 5.5%, roughly speaking. I'm going to give away the game. Whenever I have to make a choice between going with the past or coming up with this implied premium, at least for me, the choice is clear. I always go with the implied premium. In November 2013, that number would have been 5.5%. That wouldn't be the number I use today. I'll give you the updated number, but in November of 2013, that was my equity risk premium for the S&P 500 or for US stocks. Now, with emerging market companies, I'm going to take you to the process of how do you come up with equity risk premiums. And I'm going to start with that same 5.49% as my base to compute the equity risk premiums for every other market. So essentially that 5.5% you're going to see play out over and over again. So for the moment, at least, ignore what I've said about emerging markets. I'm going to take you to the process. But my point is the 5.5% becomes my base premium for the US. I want to pause and allow for questions because I wanted to at least understand the process of what I'm trying to do, as well as the intuition of why it tells you what the equity risk premium is, looking at the level of stocks, coming up with the expected cash flows, and backing out from that what the equity risk premium is. Any questions? Okay.
Yeah, I have a question.
Go ahead.
So if
Go
the
ahead, Alex.
premium, a higher premium indicates a higher expected return, is that accurate?
A higher premium means you'll earn a higher expected return. And how do you earn a higher expected return given a fixed set of cash flows? What would you have to do, Alex? What's the only thing you control as an investor?
The price.
The price, right? So if you want to earn a higher return, do you want to lower the price or raise the price?
Lower price.
Lower price. You got it. That's basically the intuition is you get scared, you want a higher expected return, you sell, you push down the price. So that's basically the process that determines implied equity risk premiums. Nitin?
Hello, Professor. Apologies if it's a dumb question. Why would this be important in the corporate finance, situation? I get it for valuing the company, it makes sense.
That's a good question. I mean, let's back up, right? As a company, you raise money from markets, you have equity on hand, right? What is the missive from shareholders? You got to earn returns higher than what we can make as investors on this money, right? Are we okay so far? So in a sense, you're investing shareholders' money. There's no such thing as company money, it's shareholders' money. So you got to look at their opportunity cost today, not what they were looking at when they invested 5 years ago, 10 years ago. This is an updated opportunity cost. And if they're scared, they want you to be scared as well in terms of where you invest your projects. So give me the alternative. So lead me through the logic, because there is a logic for corporate finance being a little different than valuation. So lead me through the logic of why you might want to, as a CFO, think about equity risk premiums differently than investors.
I was, in my opinion, I was thinking about, hey, if you know your IRR for your project, you can either take that project or you should not.
But the IRR is one half of the equation. What do you compare the IRR to?
What's you're getting for the same return? Or
how do you get that? It's not what you're getting, it's what your shareholders get on investments of equivalent risk, right?
Yep.
Today. Don't forget the today.
Today, yeah, makes sense.
So that's why we need to update the numbers. If you're in the middle of a crisis, it'll be silly to keep your hurdle rate where it was 2 years ago, because you should be more cautious about what projects you take if interest rates have gone up and you're in a crisis, right?
Yep, makes sense.
So that's why we're going with the updated premium. But I'll give you I'll play devil's advocate here. The implied premium can jump around. Well, I'm going to show you a graph. In 2020, during COVID, the implied equity risk premium went from 4% to 8%. You're going to get whiplash as a CFO if your hurdle rate keeps adjusting so much. So I'll give you an out. As a CFO, you might say, look, I'm not going to base my hurdle rate every day on a new implied premium. That's too much. My people have to take projects. So I'm going to smooth things out a little bit. I'm going to take the average premium, implied premium still, over the last 6 months, the last year, the last 2 years, to get some degree of normalcy. But I'm going to keep my eye on what's going on in markets because it's truly a sea change in markets. I've got to adjust my hurdle rates as well. So there's some argument for smoothing out, but still implied premiums, not the historical premiums, smoothing out implied premiums to get some degree of stability in your hurdle rate.
Thank
Gandharv?
When we smooth out and take the average of the implied risk premium, doesn't it create the same problem as it did with averaging out
It will not, and here's why. Did everybody get Gandharv's question, which is when I did historical risk premiums, we got that huge standard error, right? 2%. Why was the standard error so high, Gandharv, when I looked at historical? What causes standard errors to be so high? Statistically, it's got to be years in which your stocks were down minus 30% and up 40%. And with historical returns, you're going to get big swings in stock returns. With implied premiums, if you look at the history, and I'm going to show you the history in a little while, the highest that number has ever been is 2%, has been 8%. The lowest it's been has been 2%. The range is between 2 and 8%. So because the range is so tight, when I look at the standard error of a historical implied premium, it's going to be like 0.15%. You don't get the wild swings with expected returns that we do with actual returns. But that's a good question about standard errors. That's why you can get away using historical implied premiums, but not historical actual returns.
Understood. Thanks.
Professor, I had a question.
Go ahead.
In your example, you used the price of the S&P to calculate the equity risk premium.
Mm-hmm.
But an ERP is supposed to apply to the whole of the economy, right? So you're finding an ERP.
That's an excellent question. You're saying, why am I not using a broader index like the Wilshire 5000 or something that includes all stocks? Is that the question, Shruti?
Correct, exactly.
There's an informational challenge, right? Which is to get my implied, let me go back to the previous page. To get my implied equity risk premium, I need expected growth rates and earnings and dividends and cash flows, right? The Wilshire 5000, while it might be a more composite index, more companies in it, doesn't have the same degree of coverage, not even close to the S&P 500. But here's my saving grace for the S&P 500. Even though it's only 500 stocks out of 6,500 US stocks, what does it have going for it? What do you need to get into the S&P 500?
Certain market cap?
You got to have the highest, not even certain, it's the 500 largest market cap stocks in the US. There are a few qualifiers, but those 500 companies together account for about 87% of the total market cap of all US stocks.
Right.
So from that perspective, you're getting pretty close, the equity risk premium for the entire US market. Looking at, I wouldn't be able to do it if I picked 500 stocks at random. I wouldn't be able to do it if I use the NASDAQ. You know why? The NASDAQ is just a tech index, right? You take the 7 big tech companies. So you're right. I would like, if I could get it, I'd like a total equity index for the US, but then I'm having trouble getting these other numbers I need to complete it. So that's why I use the S&P 500.
Okay, got it. Thank you.
Okay, so let's talk about how to now get risk premiums for other markets. Now, if you remember when I did the historical risk premium estimate for the US, I showed you that table of what would happen if my standard error, if I had only 10 years of data, 50 years of data, and then 100 years of data. And even with 100 years, I got a standard error of about 2.1%. If I went back 10 years, and you can go back and check the table if you want, my standard error is about 4%. That's a standard error, not the equity risk premium. Or put differently, if you have 10, 20, even 50 years of data, it's almost impossible to get a historical risk premium that is even remotely, usable. The range is too big. Now, if you think about most emerging markets, in fact, forget about emerging markets, most markets outside the US do not have an uninterrupted history. That's the other requirement. The history's got to be uninterrupted. And many European markets were shut down. Equity markets were shut down during the Second World War. You don't have historical data. And forget about markets like Vietnam. I mean, the most you're going to get as historical data is going to be 9, 10 years. Markets like India, the Sensex goes back to the 1960s, but for the bulk of that period, the Sensex was like 20 companies that was the market. You didn't have much trading in the market. What I'm trying to make an argument for is historical risk premiums are a non-starter with most markets outside the US, and you're kind of stuck. If that's the only way you can get equity risk premiums, is look backwards. You can't even do it for emerging markets. And I need them now. So I'm going to take you through the process of getting an equity risk premium for other markets. And maybe you can help me, at least intuitively, to get there. Remember, this was in November of 2013. My implied premium for the US was 5.5%. I want an equity risk premium for Brazil. So I want somebody to help me out here. Mila, you can be my helper. So I want an equity risk premium for Brazil. My equity risk premium for the US is 5.5%. Should my equity risk premium for Brazil be higher or lower?
Should be higher.
Okay, so we have to add something. So to add that, I need a measure of risk premium specific to Brazil. That'll tell me how risky Brazil is. Mitt, you're shaking your head. Do we have a number for that already, and that we already talked about in an earlier session of measuring risk in a country? I'll get you started. Remember how we got risk-free rates in currencies?
Yes.
Yeah.
Yes.
And what did we use to get a risk-free rate for Brazil?
I do not remember the number, but inflation was one of the parameters that impacted
That's for the risk-free rate. But for the additional risk for Brazil, we came up with a default spread. Remember?
Yes.
The default spread could come from either looking at a government bond denominated in dollars or euros, or the rating for the country, or a sovereign CDS spread. We use that to clean up the government bond rate to get risk-free. You know what I'm going to do? I'm going to go back and collect that number, because the first way to get an equity risk premium for an emerging market is to add that default spread that we took out to get to the risk-free rate. We add it. Now, in a sense, I hope you see why I took it out of the government bond rate, because if you don't do that, we'll end up double counting risk. And I think a lot of the world people double count risk because they start with the government bond rate, which already includes default risk, and then they use a higher risk premium because this is a risky country. So the first approach to adjusting to get to equity risk premiums is start with the US premium. If it's 4.2% or 5.5% or whatever you decide to use, and add to that just the default spread. So I'll take the 3 countries we're most directly interested in. India, because I'm going to do Tata Motors, China, because I have Baidu, and Brazil, because I have Vale. I have the default spreads for each of those countries. And here I'm using the default spread based on the rating. Now, I could have used the sovereign CDS spread, but then India didn't have one in November of 2013. So based on the rating, I have default spreads for all 3 countries. So here's how I complete the process. You add the default spread on to your implied equity risk premiums. You come up with an equity risk premium for the country. It's as simple as that. It's very simplistic because I'm taking the US equity risk premium. I'm throwing up my hands on country risk and saying, I'm going to take the default spread. That's all I have. And then add that on. I hate to say this is the state of the art because this is not much of an art, but this is how investment banks and most consulting firms come up with equity risk premiums for other countries. They start with the US premium, and then they add to that the default spread for the country in question. So if you look at for my India, China, and Brazil, you end up with higher risk premiums, which is Mila's initial intuition, but that risk premium is higher because you have a default spread. Of course, if you don't trust ratings agencies, and a lot of people don't, you could have used the sovereign CDS spread. And notice how much bigger the sovereign CDS spread was for India. than based on the rating. You're trusting the market then to get this number right. And you add that number on to the US equity risk premium, you come up with an equity risk premium for a country. I continue to use ratings-based spreads because I have them for every country. Sovereign CDS spreads I have for 80 countries. But that's a choice you have if you don't trust ratings agencies. So basically in the first approach, all I'm doing is taking the default spread, adding it on to US equity risk premium. Let me pause and now allow for questions. So it's very simple, adding the default spread onto the US premium. Jacqueline?
Yes. So just a question on the CDs, choosing CDs versus the rating agencies. Is it more popular now to use CDs? I feel like I remember in the 2008 rating agencies were less trusted. So is that something that people are using
First, I
CDs
mean,
more?
first, the CDS, some countries, you won't have them for about half the countries. For the countries that you have them, here's what will usually drive the choice. If something has been happening in that country recently that makes you worried, I'll give you an example. Now, if you look at the rating for Guyana, it reflects what the ratings agency saw in Guyana in the middle of last year. But towards the end of last year, Guyana became riskier because Venezuela massed troops on the border. So now there's a lot of worry about how risky is Guyana. The rating is stale. The rating is stale because the ratings agencies take forever to reflect what's going on the ground. So if you're doing an equity risk premium for Guyana, you might say, look, I don't trust the ratings agency right now because the ratings are stale. So it's nice to have both numbers because in countries where you feel uncertain about whether the ratings agency is adjusted to things on the ground, you can go with the sovereign CDS spread. So be flexible. You don't have to pick one or the other and be stuck with it. You can move between the two. But now at least you have both choices in some countries. Michael?
Yes, excluding the US risk-free rate, if you look at the spread between the rating agency and the sovereign credit default swap spreads, it's significant. And I'm just curious, is it because the market was seeing
forget about the
higher
risk-free
risk?
rate. The risk-free rate is not even an issue. So the spreads will be different
between
now, and it will reflect, as I said, things that the market is worried about. November 2013, clearly there was something going on in India that was worrying markets. I have to go back and check to see what it was. That's why the spread is wide as that. With Brazil, it wasn't that big, right? 2.59%. With China, again, it's within bounds, 0.4%. So the numbers are pretty close for Brazil and China. But for India, clearly the market was worried about things that the ratings agency hadn't incorporated in. No. So I think that when you get big spreads, it's usually because something is happening on the ground that markets are worried about. But the ratings agency hasn't got around to adjusting.
So is the ratings agency more of like a lagging indicator?
Absolutely, right? If you know how it's a bureaucracy, right?
Yeah.
Ratings agencies are very risk averse. They're bureaucracy. The way ratings change is a group of people, and the key word is people get together, they look at the data and they make a reassessment. And they've got to be careful because if they're too quick to adjust a rating and they turn out to be wrong in hindsight, people jump down their throats. Say, how dare you lower our rating? Nothing happened. So they tend to, it took them 2 years after Greece went into conniptions in 2008 and 2009 to adjust the rating for Greece down. 2 years of meetings, so it takes a long time for ratings agencies to adjust to what's happening on the ground. And that's the advantage of having a market-based number now.
Thank you.
Mit?
My question was regarding using the US as the base. Is there a specific reason? Because there are other countries with AAA ratings as well.
That's a good point, right? And in fact, it's getting to be a shakier base than ever before. When I did this in 2013, the US had AAA ratings from when I did this in 2008, the US was AAA rated by all 3 ratings agencies. Right? By 2013, S&P had dropped off, and there were 2 ratings agencies that were still AAA. Fitch and Moody's, S&P had dropped them to AA+. Do you guys remember a few months ago, there was a news story that Fitch had lowered the ratings for the US. Now there's only one ratings agency left, which makes it AAA. We're getting to awfully dangerous ground as to whether we want to make the US the base for the mature markets. Should we be using Switzerland instead? Here's the problem though. The Swiss equity index is a mess. It's pharma companies and financial service companies. There's not much heft there. If I compute an implied equity risk premium for Switzerland, I'm not even sure what I'm computing it for. I could try Germany, but Germany has its own problems. The reality is there's no place I can go to the world and say, this is now my safety zone, because there are no safe places left. I'll tell you why, even if the US gets dropped below AAA, I will stay with the US. The information I have on the S&P 500 is far richer than the information I can get on any other index in the world. And to me, that's my starting point. The only difference is the US loses its AAA rating. That will no longer be the base premium. I'll have to adjust it down for a base premium because some of it will be country risk. So I'll stay with the S&P 500. And maybe this is just parochial of me. I've tried the DAX, I've tried the FTSE, I've tried the Nikkei. They're all problematic in terms of getting the information I need to come up with an implied premium. But that's the reason I use it as my base. Justin?
Two questions. The magnitude of the CRP is always independent of currency?
I will say a qualified yes. My qualified yes is that as long as your risk-free rates are within shouting distance. What shouting distance? Plus or minus 3% of a US dollar risk-free rate, because these are all US dollar spreads. I'm okay with it. So if you tell me you're in Australia and your risk-free rate is 5%, you ask me, can I use the same country risk premiums? I'm going to say yes. But if you're in Turkey, your risk-free rate, remember, was 15%. Help me out here. If my risk-free rate is 15%, do you think these country risk premiums should be higher or lower with a 15% base?
Well, that was going to be my question. Doesn't the risk-free, the nominal, already encapsulate some of that inflation risk?
Right? All it caps is expected inflation. This is over and above it. So as the risk-free rate rises, especially to very high level, if your risk-free rate was 60%, it's going to be a little crazy for you as an equity investor. I'll accept 65 or 67%, because that risk-free rate now has an inflation component that's wildly volatile. So at higher risk-free rates, I'll give you a way of adjusting the risk premium so it becomes higher. But I would do it only if I get to Turkey level risk-free rates.
Yeah.
Right. So that's why I said it's a qualified yes. For 90% of currencies, the answer is yes, because you're 5-6%, I can get away with it. But once you get to double digits risk-free rates, you might need to be a little more cautious.
Okay, that's fair. And my other question was, trying to think about, the spreads are for the debt market, and you're talking about equity markets. Now you're leading
me on to the next slide, because that's exactly why I was uncomfortable. When I first started doing this, I would do this because everybody did it. And then I said, these are the default spreads for buying a Brazilian government bond, an Indian government bond, a Chinese government bond. But I want to invest in equities, not bonds. So help me out, Justin. If I'm demanding a default spread of 1.2, let's say 0.8% for the Chinese government bond, should I be demanding a higher spread for equities or a lower
significantly?
Yeah. Equities are riskier than bonds. Okay. And that's why I came up with, I won't even say this, it's just one step up from what people do, but I decided that using the default spread directly was going to understate my equity risk premium. So I said, I need to bring in a measure of how much riskier stocks are than bonds. Okay. How the heck would we know it? They're both traded. So I went and looked up two standard deviations, one in the equity index in that market and the other in the country bond. So I'm just setting up an algebra problem, right? I know the default spread for the bond. If I know how much riskier equities are, I should be able to adjust that default spread for the additional risk of equities. So let's take, for instance, Brazil. The standard deviation of the Bovespa, which is the Brazilian equity index, was 21%. The standard deviation in the dollar-denominated Brazilian bond was 14%. So basically, equities are 1.5 times more risky than bonds. I took the 2% default spread out for Brazil, multiplied by 1.5. That gives me a 3% country risk premium. I added that on. So essentially, all I'm doing is taking the default spread one additional step, scaling it up to reflect the fact that equities are riskier. Using standard deviations as my proxy, and my equity risk premiums now will be higher than they were in the previous page, because I'm no longer just going with the default spread, because that's for a government bond, and I want a risk premium for equities. So let me summarize in November of 2013 where I stood. I had an equity risk premium for the S&P 500, 5.5%. I'm going to make a blanket statement about this, and now hang in there with me, even though it sounds parochial. I'm going to take the 5.5% and view that as my equity risk premium for all mature equity markets. Let me break that up into two parts. First, why do all mature equity markets have to have the same equity risk premium? Because if they had different premiums, you know what would happen? Capital would flow out of lower equity risk premium markets into higher ones. So all mature equity markets have to have a 5.5% premium, which leads to the second question. How the heck am I going to find which markets are mature? I cheated. I'm not going to do that work. I mean, who has the time and the resources to dig into countries? And besides, think of the blowback you get if you're the one classifying countries into you're mature, you're not. So I went to the very simple proxy. I looked at the rating for the country. If the rating was AAA, I said the market is mature. So all AAA rated countries are now going to get a 5.5% equity risk premium, because that was the equity risk premium for the US. If you're not AAA rated, I'm going to take you through the process that I did with India, China, and Brazil. Look up the default spread based on your rating, because I can get them for 150 countries, and then scale it up to reflect the fact that emerging markets are riskier, or equities are riskier than bonds. So here's what the world looked like to me in November of 2013. I've tried to roughly break the world down geographically. I won't spend as much time on this as I'll do on the updated version of this page, which is going to come up in 5 slides. But we notice there's a 5.5% equity risk premium for the US. Canada has a 5.5% premium. Germany has a 5.5% premium. Australia has a 5.5% premium. Singapore has a 5.5% premium. What do they all share in common?
They're all AAA rated?
They're all AAA rated. This isn't rocket science. I'm just doing, it's a simplistic, it's a bludgeon approach, all AAA. The rest of the world, the reason the risk premiums vary is because they're not AAA rated. Now do you see why if the US becomes a AA plus rated country, I'm going to have some work to do, because then you're going to find Canada will have a lower risk premium than the US, because it'll be AAA rated and the US will be AA plus. If it happens, I'm ready. But for the moment, I'm going to hold on to the one ratings agency that still gives me a AAA rating and use the 5.5% as my base premium for all AAA rated countries. Now, part of you might be asking, why are you looking up the risk premium for every country? You have a Brazilian company, a Chinese company, an Indian company, a US company. Why don't you just do the 4 countries? You know why I needed this entire global page? Let's take Disney, right? It's a US company. Does it get all its revenues in the US? It's kind of a simple question. The answer is no, right? In fact, in 2013, Disney got at about 82% of its revenues in the US. And I'm now going to make a statement about equity risk premiums that I hope you agree with, but if you don't, I'd like you to bring it out and let's talk about it. Your equity risk premium as a company doesn't come from where you're incorporated. It comes from where you do business. When Disney builds a new theme park in Shanghai, which it was starting to do in November of 2013, I can't take my US premium and transport it to another country because I'm dealing with country risk in that country in my operations. In fact, in November 2013, this is how Disney broke its revenues down. Every company will do this. So for your company, and I hope you've picked a company, check out their annual report. Somewhere in the footnotes, they'll give you a geographic breakdown, at least of revenues. Some of them will break down by assets. We'll talk about when might you want to use that. But based on revenues, this is what the breakdown looked like for Disney. 82% from the US, about 12% from Europe, about 6% from Asia, from 0.33% from Latin America. And I have the equity risk premiums for each of those reasons. From the previous page, I take a weighted average based on revenues. A weighted average, this is now my equity risk premium for Disney, at least November of 2013. Let's try to get a few guesses. What do you think this breakdown looks like in 2024? First, do you think the US percentage has gone up or gone down?
It's gone down.
It's gone down significantly. And which area do you think has gained the most at the expense of the US?
Asia, Latin America.
Asia by
because
far, right? Because you now have 2 theme parks in China, Hong Kong and Shanghai. Disney has significant operations in India, partly through its Fox acquisition of Hotstar and whatever came with it. Asia is now probably around 20% of their revenues. Europe is kind of stuck around 12%. Latin America has gone up, not that much though, surprisingly little, 5-6% maybe. But one thing that hasn't changed is the weights have to add up to 100%. This is a moving target. As company mixes change, you're going to see the equity risk premium change. Any questions on the process that I'm going through to get the equity risk premium for Disney? Eric?
I guess this isn't for Disney specifically, Professor, but just to clarify, equity risk premiums and default spreads, they can both be negative, right? So even if the US fell to a lower
Not
rating.
unexpected. Remember, these are expectations. The actual returns can be negative, right? Because stocks can do badly. But if you're stepping in to invest, it wouldn't make sense for you to invest in something with negative equity risk premiums, because then you're saying, I'll accept less than the risk-free rate. So that's why implied premiums will always be positive. Historical premiums can be negative, but implied premiums always should be positive. And they should be more positive for riskier countries.
Okay. So even if the market disagreed with the Fed rate or something like that,
it shouldn't matter, right?
You
because
still would not see.
You're still building an expectation. Those expectations might be unrealistic, right? In hindsight, you might say, you guys were crazy to estimate a 6% growth, but you price things based on those expectations. And if you price it based on expectations, you should always get a positive premium. That premium can get small if you're being over-optimistic. And I'll show you a graph of what happens when you have a bubble. Because then you're going to tell me what you think you will make, and then I look at what you price things to make. You can get very different numbers.
Thank you.
You're welcome. Yeah. Now let's look. Go ahead, Abrar.
Sir, when a company is entering into a new territory, new country, like Chevrolet came to India, of course, they have some strategy to have a profitable business, but did they go somewhere wrong in the corporate finance, like fundamentals? That's why they had to retreat and like pull back.
Well, I think there'll be multiple things that can go wrong. First is that you underestimate your hurdle rate. So if you're a US company in the bad practice of using US hurdle rates, and you decide to go to the Ivory Coast, or you decide to open a business in Nigeria, and you use your US hurdle rates, you're charging too little. So one thing that can go wrong is you charge too little a hurdle rate, the risks come in and say, oh my God, we didn't see this coming. You should have. You back up. So that's one thing. The second thing is your hurdle rate can be right, but you walked into India saying this is a big market, everybody will love Chevys, therefore, will sell a lot. And then you find out that Indians don't even know what a Chevy is, or they don't care what a Chevy is. Nobody's buying Chevys. They'd rather buy the Korean cars. It can blow up in your face, right? The third is you can get the hurdle rate right, your expectations can be set reasonably, and then the country goes into hell in a handbasket. Pure luck, out of your control. In other words, in hindsight, failure has 1,000 potential parents. It's good to know. So later in the class, one of the things we're going to talk about is when you have an investment that's failed, is it important to know why it failed? I think it is, because, and not everything that happens is the management's fault, right? You keep firing managers every time they fail. Abrar, help me out. What are managers going to do when they take risky investments and they fail and you fire them? What's the natural strategy of management?
Pass the ball.
Or either that or don't take risks at all, right? The old, the top-down companies, that's why they tend to be very risk averse, because you get punished when it's not even that you make a mistake. Risk cuts both ways, danger and opportunity. Danger means that sometimes your investments are going to come in worse than expected. And if I keep punishing you every time you're exposed to danger, you're just going to go into a cocoon and say, look, I'm never going to take risks because I keep getting punished. No. This is why when you see disruption, it tends to come from who? Not the status quo. They have too much to lose. It always comes from the outside. There's a reason the largest electric car makers in the world are not called Volkswagen or GM or Chrysler. They're Tesla and BYD. So I think you're raising an interesting question of why do projects go wrong? We'll come back and dig into that. But hurdle rates are just one piece of a very big puzzle. So let's talk about the rest of the companies. And now you can see why my point about it's where you do business that drives your risk, not where you're incorporated. Okay. Bookscape was easy. Remember, it's a New York City bookstore. I use the US risk premium. Are there any caveats? Maybe if all your tourists are German tourists, don't ask me why. You're a New York City bookstore. Why would you attract just German tourists? Maybe you sell only German books. Then maybe I might consider the German equity risk premium. But clearly, this was my easy one. Vale, Brazilian company, right? But where does it get the biggest segment of its revenues? Take a look. Oh, it's China, 37% of its revenues. Vale is more a Chinese company than a Brazilian company, because guess where the iron ore was being consumed in 2013? The country where the biggest infrastructure being built was the largest customer. So when I look at the equity risk premium for Vale, it's a weighted average, with China being the biggest weight. Tata Motors is very close. You see, why is Tata Motors getting so much revenue in China? I'll wager you will not see a Tata car in China. So what exactly is giving its China revenues? Gandhar?
Is it the fact that they own Jaguar?
It's Jaguar Land Rover. Don't ask me why, but the Chinese seem to drive like driving Land Rovers. Where you drive those monstrously big vehicles, I don't know. But they're clearly it's driving it. In fact, today, I think if you look at the breakdown, I think China might be the largest market, though in the last couple of years, their Indian production has gone up. Now, Tata's, so weighted average. Baidu, I've never spoken to a single person outside China who's ever used the Baidu search engine. I might be completely wrong, but this seems to be an entirely Chinese company. And Deutsche Bank is all over the world. It mangles every part of the world, but it's all over the world. Weighted average. So my point is a broader one, which is companies, when they think about country risk premiums, can't think of where they're incorporated. They have to think about where they're taking the next project, what the mix is, because that's what's going to drive the equity risk premium used to come up with your hurdle rate. Now, I am very fond of implied premiums for lots of different reasons. I use only implied premiums, both in valuation and in corporate finance. And one reason I like implied premiums is they reflect the world you're in. Now, in until about September of 2008, I used to compute the implied premium once a year for the US and use it all year. And when people push back, I'd say it's a mature market. How much can equity risk premiums change during the course of a year? And then we get to the end of 2008, you can see how much equity risk premiums can change in the course of a year. This is the the 2008 crisis. It started on September 12th. That was a Friday. I remember on that Friday, opening up the news stories, and there was a story that this, Lehman was looking for a buyer, and that Barclays was interested in buying Lehman. I went home that weekend not expecting much to happen. Barclays will buy Lehman by Monday. Everything's going to be okay. Woke up to the Monday, to the crisis. And this is actually the implied equity risk premium every day from September 12, 2008. Starts at 4.5%. There's a day in November where the equity risk premium hit 8% in the US. This is a mature market. You're seeing that this is what happens during crisis. The price of risk just explodes. People get scared. And by the end of the year, the premium is down to 6.4%. Every crisis since 2008, I've done exactly this, compute the implied premium every day, because I want to see what the market is pricing in. So again, this is during COVID, the first, if you remember, February 14th of 20, from the start of 2020 through February 14th, things look pretty normal. Then, of course, you had the Italian government announcing that they'd found, 200 COVID cases in Italy, and then the crisis takes off. By March 23rd, it's in 6 weeks, the implied equity risk premium for the US had hit 8%, and by the end of the year, it was back down to 4.5%. The difference between 2008 and 2020, in 2008, took almost 4 years for the implied equity risk premium to come back to where it was before the crisis. 2020, it was back to where it was September. And this goes back to Mit's earlier question. If you're a CFO, do you really want to use an 8% premium on March 23rd, or do you want some smoothing up? And there, I think you can make an argument that maybe reacting too much to a day-to-day number can create these disruptions. So you might have, and you'd have been okay. You'd have been, in hindsight, everything would have been okay. Your worry is if it goes to 8% and stays at 6 or 7%, and you've normalized, then you've taken projects you shouldn't have. So any questions on why the premium is changing? The premium is changing because stock prices are changing dramatically. When stock prices change dramatically, the risk premium will change. Every crisis is caused by the price of risk changing dramatically. Why? Because cash flows can't change overnight. Growth rates don't adjust this much, but people can get scared overnight. In fact, during the Brexit election, election in 2016, I did this on the FTSE by day. This year, the Indian election's coming up. You can do it on the Sensex. Remember, you can do this on any index. It'll give you a sense of what the market is pricing in as changes in risk and risk premium around big events. Any questions?
Yes. So why why you use the dividends and buybacks instead of some income measure to compute the?
Because you don't collect income. It's a cash flow, right? Cash flows are cash flows. You can't collect income. I'm starting with income to get to dividends and buybacks. It's not like the income doesn't matter. But in any intrinsic valuation, income is just a starting point. You can use the income to pay dividends. You can use the income to have free cash flows. But income by itself should never be the driver of value. It's a cash flows you get from the income. That answer your question?
So how is that different from free cash flow?
How is what different? Dividends and buybacks or earnings?
Yes.
Dividends and buybacks are, in a sense, observed free cash flows, right? Free cash flows to equity. Let's be first clear. Free cash flow by itself is incomplete. Is it to equity investors of firm? So one measure of free cash flow to equity is look at what you actually get as equity investors. Dividends and buybacks are actually tangible free cash flows equity. Now your argument is, what if companies are not paying out what they can afford to? In that case, you can try to compute the free cash flow to equity for every firm. That's potential dividends and buybacks. Right? But that you'd have to do for each of the 500 companies. I'm lazy. I have to do this every month. I don't want to do free cash flows to equity for every company and add them up. So basically, I'm using dividends and buybacks as essentially a measure of what the companies can afford to pay out over time.
So is that accurate compared to the free cash flow method, or is there an
Free cash
adjustment
flow
that should be
equities are
made?
not accurate either, right? They're both estimates for the future. So if I gave you the free cash flow equity for last year and dividends and buybacks for last year, they might be accurate for last year. They're both accurate reflections of what you did last year. But what's your job for the future? It's to forecast what these numbers will be for the future, right? So it's going to be an estimate anyway. The question is, are you better off doing this estimate on free cash flow equity or estimate? They're both rough estimates. You're going to be wrong on both of them. Question is, which one are you going to be more wrong on? The one caveat is, remember, computing free cash flow equity for financial service companies is a nightmare. It's tough to do. We give up all the time. And the S&P 500 has a big chunk of financial service companies. And those companies, you're going to be stuck using dividends and buybacks because you really have no alternative. But you could do this. And so when I do this in foreign markets where I don't have the buyback number or there is no buyback number, I do use free cash flow equity.
Okay, so it's more about what's practical.
It's what's practical. In the US, roughly speaking, the dividends and buybacks are a pretty good proxy for the free cash flow equity. In India, dividends and whatever the buybacks might be small amounts are not good proxies. There, I would go with free cash flow equity. Abrar?
Sir, I have a question, like might sound a little bit loaded. So let's say there is a groundbreaking technology that has been invented by one of the like any kind of company, like let's say it's in rocket science or something like that, and they are the first to do it. But they are being brought to consensus by the government, saying that let's wait till 2 more years till the elections comes up, so that you can implement that in like full scale like production and getting this technology out. Right now, of course, like you're the first to do it, you have the complete test done, but you haven't done the launch or something like that. Like the government is like, wait till 2 years till the elections, and the company says yes to. So there are two scenarios. One is I start the production now. One is I wait till the
Before you
election.
go on, though, this is a very company-specific question you're asking. It's going to affect the value of the company, what you put into it.
Yeah, like
It's
as
got
a
nothing to do with
whole.
equity risk premiums, right? So in a sense, can we hold off until we talk about betas and company-specific questions? Because the equity
Yeah,
risk
but
is the entire market.
It's not company specific. What I'm asking is like, if it is released later, the government will be more stable. And a stable government means a stable economy, like better ratings and stuff. So
So
for
you're
the
saying this company's technology can basically alter country risk? Is that the point you're making?
like if they release that full production, like at the date of elections,
and forget all about all of that. So let's say it plays out as a more stable government if the technology works. The only thing we care about at this stage is how will it affect country risk. So you're saying that if the technology works, you'll have lower country risk. If it doesn't, then you're going to have higher country risk. Is that?
Now, I'm basically asking stable government versus a groundbreaking technology, which will basically like kind of be better for the risk.
For a country risk premium, it's always the government. The technology affects cash flows. It might make the economy more productive. We're looking at the denominator here. It's about stability. That's why you can have a stable, bad government, right? Because what defines stability? That you know exactly what to expect, right? So you can build in a stable, bad government. Your economy will be not a very good one, but you'll have low country risk. Okay? So I think that you can, if on this dimension, it'll just be the stable government that determines your country risk. So let's update it, so, right? Because what I showed you was November of 2013. You're saying, what does the world look like at the start of 2024? So the index is now at 4,000, at start of 2024 was at 4,770. Dividends and buybacks have become even more skewed towards buybacks. 60% of the cash flows come from buybacks, 40% from dividends. The expected growth rate jumped at the start of 2024 for two reasons. One is 2023 was a flat year for S&P 500 earnings. Earnings came in. And second, because, for better or worse, analysts have become less worried about a recession. They've upped the earnings estimates. So at least for the near term, they see significant growth in earnings coming out of 2023. I get the expected earnings and the payout. And this is why I said ultimately earnings are starting point to get to cash flows. And I set up the equation just as I did in November of 2013. So there's what I'm paying. There are my cash flows. No, I solve for a required rate of return, 8.48%. At the start of 2024, US stocks were priced to earn about 8.5%. You subtract out the risk-free rate, 3.88% that day, my implied equity risk premium at the start of the year was 4.60%. It was only, what, 2 months ago, right? I just want you to guess based on what we've talked about. Just think about the mechanics. What do you think's happened to that premium in the 2 months since I did this? First, I'm going to pay Eric. Let me give you the easier half of the equation. The T-bond rate was 3.88% at the start of the year. Do you have a guess as to where it is right now? Higher
It's
or lower?
been a little bit since it's higher. I would say it's like 4.1.
It's about 4.28%. Yesterday, I was surprised. I looked at it. It's jumped, especially in the last week, 4.28%. So if I change nothing else, if I just increase my risk-free rate, is that going to lower my premium or raise my premium?
That should raise your premium.
Lower it.
No, if my cash flow stays the same and my expected return on stock stays at 8.5% and I raise my risk-free rate, I should have a lower premium because remember, it's over and above the risk-free rate. Now let me turn to the other side of the equation. Now, Michael, help me out here. So what's happened to stocks since the start of this year? They started the year at 47.70. You have a rough sense of where the S&P 500 is right now?
5,000.
5,000.
It broke 5,000 recently.
Holding all else constant, if stocks go up, what happens to the expected return on stocks? Higher prices, lower expected return, right? Because in a sense, you got the same cash flow, you're paying more upfront. So if the risk-free rate has gone up and the expected return on stocks has gone down, well, mathematically, you can see what's happened, right? The equity risk premium today is lower than it was 2 months ago. I told you I update these premiums at the start of every month. The end of the month is obviously coming up in a week. I'm expecting to see an equity risk premium around 4.4%. It was 4.5% at the start of February. I'm expecting to be down to about 4.4%. Unless something weird happens in the last 7 days. Remember, markets can turn on a dime. You can have a 1,000-point day, and all of a sudden you're looking at a much higher equity risk premium, right? But given where things are today, you're looking at an equity risk premium, probably 4.45, 4.4%. I want you to constantly remember those dynamics. Stock prices go up, stock prices go down, risk-free rate goes up, risk-free rate goes down. What happens to the implied equity risk premium? Now, another way to frame this issue, and this goes back to its question of if I'm a CFO and I'm looking at this 4.6% premium, can I use it? Is it a high number? Is it a low number? Just to give you some perspective, this is what the historical implied premium, this is not the historical actual return, the historical implied premium for US equities have been for the last, since 1960, 65 years. They're the 1960s, incredibly stable period for US equity risk premiums. 1970s, they're exploding, right? People are getting scared. What was driving it? Inflation. Inflation is deadly for stocks. It makes people more scared. Pushes up the equity risk premium. Peaks at 6.5% in 1978. Absolute bottom of the market. 1978 through 99, one of the great bull markets of all time. By the end of 99, take a look at what the equity risk premium had become. 2%. At the peak of the dot-com boom, people were just asking nothing for risk. I was around then, and I remember stories going around saying there will never be another recession again. I'm not kidding. People were taught the peak of the dot-com boom. They said there'll never be another recession again. This is now the tech world. We've discovered the solution to recessions. And of course, they were wrong. There was the dot-com bust. Then for about 5 years, you get equity risk premiums around 4 to 4.5%. And then you get the 2008 crisis. And since 2008, if you take a look, equity risk premiums have become both higher and more unstable. There's, I think, a good reason for both. Why do you think after 2008, we've had both higher and more unstable premiums? Anybody want to guess? What is it? What's happened to the world since 2008 that's made clearly what you're getting from the equity market? The world is a riskier place, right? That's the message you're getting. What is it that's changed, you think?
The macro shocks.
Macro shocks. So, Mela,
More
go ahead.
often.
And
Yeah,
why
more
do we
often
see
now.
more macro shocks more often? I mean, haven't we always had macro shocks? What's different about 2020 as opposed to 1980?
We're globally more connected. Supply
In other
chains
words,
are more
everybody's
interconnected.
macro shock becomes everybody else's macro shock. In the 1980, if you had a recession, it was really, I mean, you had a recession in India. Nobody in the US even knew you had a recession. Now you have a recession or a problem in a country, especially if it's a larger country, you see the spillover effect. So one is globalization. We're all connected at the hip. Jinko?
So I was just gonna say like housing crisis and also like just people
But
doesn't
that
trust
should
the
have,
market.
that ended, but in 2011, right? And that was
Yeah.
more US than anything else. So this is a global phenomenon. So the housing crisis, if that were the case, that should have gone away by 2012. We should have been back to numbers as stable as they were before 2008. That didn't happen. So it has to be something global. Like, you know, like there's another issue, and go ahead, Jinko.
I'm thinking maybe I'm guessing, maybe I'm wrong, but is that has anything to do with the because technology was accelerating and people can spread like fears and informations like more wide.
We blamed everything else in social media. Might as well blame equity risk premiums on it too. You know, Mark Zuckerberg is but I think you have a point, which is we're globalized and connected, and the way we're connected is also through social media, which is if there's a crisis, it's not like the crisis stays isolated because the news can spread faster. I'm not suggesting it's a lead cause, but I think it's a secondary factor in why news spreads so quickly and why rumors can spread quickly as well, right? Alex?
Yes, I'm wondering if you have any information on the correlation of the implied premium with the historical premium?
It's usually negative, and there's a reason, right? When stock prices go up, historical premiums actually increase, implied premiums go down. In fact, that's one of the reasons I go with implied premiums, because historical premiums always work in the wrong direction. You're in a crisis, you sell off stocks, the historical premium goes down. Why? Because you added a bad year of returns. Implied premiums go up. So the correlation is actually negative between the two numbers. And when they're negative, it's actually the implied premium that's telling you where you are in the world, not the historical premium.
So if you have the historical premium for a period and then you have the applied premium covering the same period, that's what I'm asking about.
Yeah, and that's what I'm telling you is the two will tend to move in different directions, especially in periods when the market is doing contortions, either going up a lot. So you remember the 99 premium, this was when historical premiums were maximized. Peak of the dot-com boom, your historical premiums are high because you're coming off this great decade for stocks. So if you put a historical premium graph, overlaid it on this one, it'll be almost the inverse of the movement that you see here on implied premiums.
So the implied premium is a good, better
Forward
predictor
indicator.
of future
So
returns.
basically, one is a better forward indicator. The better is the historical premium is the reflection of what you actually did over the decade. But now I'm asking you, what will the next decade look like? And what this says is, if you came off a really great decade, the next decade is probably less likely to be good because you're coming off a high price now.
Makes sense. Thanks.
Smith?
I was wondering the recent increase in implied risk premium is because of the decline in global stability and trust in the US financial markets.
Trust in all. We've lost trust in all institutions. Don't just make it about US financial market. We've lost trust in governments. We've lost trust in central banks. When you lose trust, guess what you see? You demand a higher risk premium. I'll give you another thing. I just wrote a piece on my blog last week. If you get a chance, you can read about catastrophes. Yeah. Let me ask you a question. This is a stupid question. Can catastrophes happen? The answer is yes, right? And I think there's I don't mean to be a doomsdayer, but there is a greater worry that people have about catastrophes now than 20 years ago. One catastrophe, obviously, that if you're environmental, you worry about is climate change. It's clearly you're saying, why should that matter? When you're pricing equities, do you have to worry about catastrophes? Absolutely. The more you worry, the larger the premium is. There's, I think, a catastrophic component to equity risk premiums now that is larger than it used to be. We used to worry about natural disasters, a nuclear war. That's now been replaced with climate change and a nuclear war on top of it. And that's pushing up premiums as well. That's why I think about equity risk premiums as a barometer of where the world is now, because everything kind of shows up in it. Vera?
Yeah, Professor, just to answer those reasons why we're seeing implied premiums is relatively high in the past decade or so, I was just wondering, could it be because after the financial crisis, so the Federal Reserve basically keep the interest rate pretty low? So could it be the reason is that kind
come
of...
on, we went through that, right? The Federal Reserve didn't keep rates low. What kept rates low? Low
okay.
inflation and low real growth. The Fed is a follower.
Right.
Let's not make the Fed a lead actor. The Fed
Okay,
is
sure.
always
Yeah.
a walk onto the stage, right? So
Right.
it's easy to
Yeah.
say that central banks did it to us. But
Right.
unfortunately, the central banks are players in this game, just like the rest of us. And I think it's a game that's changed. And the central banks are just onlookers of that game. But I do realize central banks have become more active in the last 15 years than they used to be, and that could be contributing to risk as well. That's a strange thing to say, but I think a good central banker should be seen and not heard. It sounds like an absurd thing to say. And we're hearing a lot more from central bankers than we really should be. I don't think it's healthy. And I do think it's adding to the risk component. To live around every FOMC meeting, what will happen? It's not a healthy sign for markets when that happens. But I think you have a point about central banks adding to the risk.
Oh, thank you, Professor.
So the previous graph I'd put through 2022. There's my 2023 updated graph. So 2022 was a bad year for stocks. Equity risk premiums shot up. And if you think about why, it was the year inflation came back after a decade of staying low. You see what happened in 2023? Some of the fear about inflation went away. Equity risk premiums went down. So the fears about an economic recession went away. The equity risk premium went down. And starting 2024, we're starting in good shape, right, in terms of those numbers. And that scares me. And here's why it should scare you, because what are we doing? We're pricing in the expectation that there will not be a recession. That's we're saying rearview mirror, we were wrong. We're also pricing in the expectation that inflation has come down and will stay down. Just as we were wrong in 2023 in the other direction, could we be wrong in 2024 on both those dimensions? Yeah, in fact, last week, if you remember, there was the inflation number came out. It turned out to be higher than expected. Markets freaked out. So don't get too comfortable saying we're in a good spot. Nothing bad is going to happen this semester. It's not going to be like 2008 and 2020. You saw how quickly things changed in 6 weeks. I'm not wishing this on you, but you could be waking up to 8% premiums in the middle of April if you have a crisis. I don't think there will be one, but who knows? That's why you do implied premiums. So I'm going to update what I did in 2013 for equity risk premiums. You remember I computed the equity risk for every country. So At the start of each year for the last 30 years, I've been computing these equity risk premiums by country. So start of 2024, I started with the US equity risk premium. I explained why. It's implied premium becomes my base. I checked out the rating for every country. It's AAA rated, I give it the US premium. If it's not AAA rated, I come up with a default spread. And I use that default spread to come up with an equity risk premium. The one thing I've kind of decided I have to do to get this going for every country is, remember, for each country, I had to look up the standard deviation, the equity index in that country, and the standard deviation in the government bond in that country. Unfortunately, that you can do that only in countries with government bonds. There are about 130 countries where there's no government bond. And even the 30 countries that have government bonds, they have to be traded. That reduces the list to about probably single digit countries where the bonds are traded where you can trust the rate. So here's what I've taken to doing. I've taken to computing one scalar for the entire group. And basically the way I get the scalar is I look at the standard deviation of an emerging market equity index. I think this index comes from S&P. It's an S&P emerging market equity index. And the standard deviation in emerging market government bond index. So basically, I'm computing one ratio and applying it to every country. So if your default spread is 2%, I'm going to multiply by 1.34. That's 2.68%. Add it to the 4.6% and come up with an equity risk premium for your country. So here's my updated picture for the world. And I'll talk more about this next class, but basically for every country, you see in blue the rating. In red, you see the country risk premium for that country. And in green, you see the total equity risk premium. So again, US, Canada, and I'm holding on to that last strand for the US, Moody's AAA. I have a 4.6% premium. Let's take Asia. If you look across Asia, the only country with 4.6% premium is Singapore because it has a AAA rating. But look at the spread. The highest equity risk premium in Asia at the start of 2024 was Sri Lanka, 22.15%. And if you're familiar with what's been happening in Sri Lanka in the last 2 or 3 years, the country is in chaos. The government is in chaos. The economy is in chaos. Laos is next. I mean, but you can look across, and when you tell me you operate in Asia, you see why I'm going to ask you a follow-up question. Tell me where. If all of your revenues come from China, I'm going to, or from India, it's very different than if they come from Cambodia and Sri Lanka, because the equity risk premiums are so different. One final point before I finish, if you look at and you can check through, and the one thing I would caution is if you're from any part of this world which is not the US and you're upset about the equity risk premium I gave you, it's not my fault. Do you see why? If you have a country, let's say you're from Sri Lanka and you say, this is terrible, you're punishing us with a high equity risk premium. I'm not doing it. You know why your equity risk premium is awful? Is because I start with one of the lowest ratings I see in the world, CA. When you get a low rating, you get a big default spread. You get a big default spread, you're going to get a high equity risk premium. So it's no magic sauce here. It's US implied premium as a start, the rating for your country as a measure of country risk, and a scaling up that premium to reflect the additional risk of equities of pretty much every country in the world. So I would strongly encourage you, if you haven't picked a company, to pick one and then look through its annual report to see where it gets its numbers. And I've actually computed regional averages. These are weighted average, weighted by the GDP of each country. So you're getting a number that reflects what that part of the world requires as an equity risk premium. Try to get an equity risk premium for your company. You can use my estimates. They're start of the year, they're 2 months old. They're pretty close to where the numbers would be today, so you don't have to do this from scratch. But if you're curious, you can always delve in. And I'll send you the link so that you can actually look at the entire Excel spreadsheet with these numbers and see why the numbers are what they are. But I want you to get comfortable with why equity risk premiums are different across countries and why your company will have them. Jinko, last question, and then we'll close up.
Professor, just an additional question. if you look at the scoring, does it make sense that Spain has the same like rating with almost the same rating as Greece?
You know what? I can send you the Moody's email address, Jinko, but this is and that's going to be I'm going to bail on this because in a sense, trusting ratings agencies comes with a cost. And Jinko raised an interesting way. What if the ratings agencies are wrong? You know what you can do to check that, Jinko? What could you check to see if the ratings agencies have got this wrong?
Okay.
You could go to the sovereign CDS market, right? And you can see whether the sovereign CDS looks very different. And if you feel that the ratings agency has got something wrong, replace the rating-based spread with the sovereign CDS spread.
Okay. Okay, thank you. Oh, I'm just like speaking out of like common sense because obviously Greece is in a really bad place and Spain, you know what I
So
mean.
what are the two countries that you see having the same rating? Spain and who else?
Spain and Greece. Because
Greece
in
has
my
come down a
opinion,
lot.
Spain
I
is
mean,
like,
I think your vision of Greece is based on the crisis. I think
okay.
you need to take a look at what Greece has done. It's really impressive what they've done to bring their risk down dramatically. I'm not surprised at all that Spain and Greece are coming in equal risk because the Greece of today is not the Greece from 10 years ago.
Oh,
Not
okay.
even close.
Thank you.
Okay, folks, that's about it. Thank you very much for dialing in, and I will see you in class physically Monday. So don't show up on Zoom that day. I want you in person in class. Take care.
Thank you.